First of all, I will start by saying that when it comes to policy tightening, there are effects, a slowing economy in the hope to curb inflation, which, as you say, remains sticky, but there are also side effects. And one side effect is that certain financial institutions end up struggling. You see, interest rate hikes, higher rates is not always good for banks, not always good for financials. Part of me wants to think that SVB is idiosyncratic, and after all, it's a special type of institution. There's a mismatch between assets and liabilities, and narrow and specific client base. It was the bank for the tech industry in the Silicon Valley. But also, we need to admit that there's an element of systemic risk here. So I think what the Fed should do is to be cautious for the time being. I think they will raise rates, probably by a quarter point. Possible that they don't do this time around, but I think they will and should resume their rate hiking cycle.
So that was a very even-handed summary of the situation. Moody's today, though, or in the last 24 hours, have gone to negative from stable on the US banking sector. They're talking about ALM, which is asset liability management, and they're saying that the whole SVB situation has highlighted some real problems with ALM. Do you think that it is a systemic problem in US banks?
I don't think just yet. I wouldn't describe it as systemic per se, but it's possible that there are other institutions. The rating agencies lag a little bit. The market is already there. We may have other cases. The point is that the Fed should raise rates even if core inflation was half the level that we have now.
Sorry, why did the Fed do what it did and the authorities rush in if there isn't a systemic problem? Why not let this one go unless there was a bigger problem in US banking?
Well, I think, for one, you want to prevent a continuation of deposit outflows. We have seen some of it, not generalized, but certainly in some institutions. Secondly, you don't want that this becomes a systemic problem. Should it be one? Should there be other cases? But look, it's not a blanket guarantee. It's not a blanket check either. And so they're trying to strike a middle ground between mitigating risks of financial instability, while at the same time the monetary policy side of it should continue to raise rates. If not big time this time around, I think they should at the subsequent meetings.
I know some economists believe that this is just a root cause of central banks having printed too much money for too long. The retreat is just extraordinarily very difficult to bring around. If you think about what German Bunds on this side of the world have done in the last 2 years, from 0 to 2.5%, that is a fairly extraordinary move in a safe haven asset as well. So in that context, should central banks continue to get going on this side of the world in terms of normalizing policy?
I think this is actually a very valid observation. First of all, this problem, this issue is arising because interest rates were too low for too long, and so certain lending practices went too far. Now, lending standards are tightening. So, but generally speaking, maybe central banks move too fast. Yes, there is a reason for that, and the reason is that inflation is sticky. This side of the Atlantic, core inflation has not even peaked. And the main point is that even if it does peak at 6% or so, the level is far too high. And to bring it down, there is a trade-off. The trade-off is slowing activity. The trade-off is also some side effects on the financial stability front, and the regulatory arm of central banks is there to mitigate those.